Today, we want to take you through our views on the economy and how that translates into our strategies across the markets. Joining us today is Marco Bravo, a senior portfolio manager, and also the one who leads our economic outlook group. Elizabeth Henderson is the director of corporate credit. Scott Edwards oversees our structured product group. Greg Bell is the director of municipal bonds. Tim Seneschal is a senior portfolio manager and leads our relationship with Zazoff Associates in convertible bonds. And Scott Skoronsky is a senior portfolio manager and leads our relationship with Muzinich in the high yield and bank loan space. So let's turn it over to Marco for our economic review. Marco?
Thanks, Reed. Well, we started the year off in a relatively strong fashion, but what a difference a few months makes. And the sudden stop in economic activity during March and now into April has led to some really ugly data reports. Confidence and activity indicators have fallen off a cliff, as shown here on slide 4. The recent reading for consumer sentiment fell by the most ever, reflecting concerns over health and employment conditions. And the last time we saw industrial production fall as much as it did recently was when the U.S. was coming out of World War II. In addition, this month we saw retail sales take a steep decline, although consumers did stock up on groceries and other essential items. And the following slide shows what happens when you go from a full functioning economy with a historically tight labor market to a broad shutdown, which has wreaked havoc on the labor sector. Even with the government's attempt to keep people on payrolls, over the last 4 weeks, we've seen over 22 million individuals file for unemployment. That has completely wiped out the number of jobs created since the end of the 2008 recession. Most economists today expect the unemployment rate to move well above the 10% level for the coming month. Now, once the economy does begin to reopen, we would expect a number of these jobs to come back, although it's unclear at this point in terms of the speed at which these jobs will come back. It's also probable that some jobs in certain industries like energy and retail, to name a couple, may be lost for good. This uncertainty regarding job recovery, we think, could lead to depressed consumption and a slower overall recovery in economic activity. On the following slide shows the outlook for GDP growth, and the outlook for growth for 2020 can best be described as highly uncertain. What we know for sure is that the downturn in the first half will be bad. What we don't know is the severity and the length of the downturn. Current consensus estimates project GDP to fall by an annualized rate of 14% for the first half. To put that number in perspective, that would be double the worst two-quarter decline since 1947. Even more uncertain, though, is how the recovery will look. Assuming we do begin to reopen the economy this month in May and into June, the estimate for growth in the second half is currently 8% on an annualized basis. This would result in a total economic contraction of about 4% for 2020. As we think about the second half and even going into 2021, we believe the pace of the recovery will depend on understanding the health risks through testing and how quickly jobs come back. We think that continued social distancing, either due to changed behaviors and or government mandates, will slow the pace of job growth. And then adding to the uncertainty is the potential for a second wave of the virus coming back in the fall. So to sum up from an economic perspective, these are unprecedented times that we're living through with continued significant uncertainty. So with that, I'll pass it back over to Reed.
Thanks, Marco. Okay, so just a reminder again, if you have any questions, type them in. But as we think about what was happening in the markets, March was unlike anything we have ever experienced. As it became obvious that the entire country was shortly to be at home, significant selling took place, but also on the run treasuries, significant buying. On March 3rd, we purchased $2 million of an on the run 10-year treasury for a client. Settlement was delayed by 2 weeks because the dealer was short several $billion of that issue. Multiply that one dealer across the entire market, and you can see the dislocation that occurred. At the same time, when we went to sell off the run treasuries during this period, we would put bonds out to 5 or 6 dealers, and only one would come back with a bid. Across the treasury sector, the bid offer level moved from less than 1/10 of a point under normal times to well over 2 points. But happily, the Federal Reserve was experienced with these types of dislocations. The playbook that took months to develop during 2008 was rolled out really in a matter of days. Liquidity was first restored to treasuries and agency mortgage-backed securities, and is coming back to our other markets as well. It certainly has been a very interesting time, but let's talk about what's happening with corporate bonds. Elizabeth, take it away.
All right, thanks, Reed. Similar to the equity market, the investment grade corporate bond market experienced a historic level of volatility, with spreads widening over 250 basis points in March on the increasing risk of defaults and rating downgrades. As the economy shut down, cash flow projections became highly uncertain, raising not only liquidity but solvency concerns. So the jump to default risk in investment grade was real and materialized given the inability of companies to access the new issue market. The Fed's programs quickly helped get markets functioning again, as Reed talked about, and specifically in corporates, the Fed's program that targeted the new issue market, offering $500 billion to U.S. companies. So you can see the reduction in default risk in this graph on the right as the investment grade OAS dropped, more typical for an industrial-led recession. Moving on to the next slide, the bond market wasn't immune to the panic selling as well, and we saw rapid selling by mutual funds and ETFs with really no buyer on the other side. The Fed addressed this by creating another corporate bond program, which provided $250 billion in liquidity to the secondary market. So both of these programs have reduced technical and liquidity-related risks, as funds and ETFs have now become buyers once again. So now that markets are functioning more normally, what are we expecting to happen to credit fundamentals? Projecting cash flows is a highly uncertain exercise given the degree of unknowns. Using a more conservative estimates for cash flows, we're expecting a loss in 2020 of around $375 billion from this shelter-in-place and virus, which is effectively what is generated in 1 quarter by non-financial companies. So companies have filled this cash void largely by issuing new debt over the last month. If the economy does not recover as quickly as expected, and this expectation proves to be too small, other sources include bank line liquidity, working capital adjustments, as well as cuts to dividends and capital spending and share repurchases. Therefore, this, as well as the Fed programs I just talked about, allay these liquidity concerns. So then how might credit profiles change? One way to look at it is taking that expectation for cash flow deficiency with the additional debt and projecting leverage, which for the market you can see here is increasing effectively 1 rating notch. However, if you really dig down, you see that that increase is being primarily driven by 3 sectors, which is shown on the graph on the right, and those are most affected by the virus and related shelter-in-place orders. So on the next page, you can see the rating agencies recognize this and were very quick to downgrade issuers in sectors most impacted by the virus and these orders. While they were quick to act, the pace has slowed now, and we expect them to pause until we have more clarity regarding the recovery. And each of the three main rating agencies have very different GDP estimates for 2020. So we're expecting a slow recovery starting in the third quarter, as Marco talked about, with uncertainty surrounding a second wave in the fall. So given our expectation that we're not going to see a V-shaped recovery, we expect more rating downgrades, including another possibly 250 to 350 billion of fallen angels. We've shown the sectors most at risk in this pie chart below. So where does this leave us in terms of positioning? Spreads today appropriately reflect the recessionary conditions, including the risk of rating downgrades, which had not been the case before March. That said, we're not ready to get aggressive with risk because we still believe the risk of a second wave in the fall and then longer than expected potentially shelter-in-place orders will keep volatility high. Therefore, we believe insurance companies should be investing in higher quality companies and more defensive sectors and triple Bs. We found financials more attractive over the last 2 weeks, for example. So taking advantage of statistically attractive spreads by being overweight your index in corporates while protecting your downside is essentially our thesis in corporates. So now I'd like to turn it over to Scott Edwards to discuss structured products.
Thank you, Elizabeth. I'll pick it up on page 14. As Elizabeth pointed out, on the structured product side, we're attempting or positioning similarly. Now is not the time to be taking incremental risk. We really believe that it's better to position yourself higher in the capital structure and in higher quality assets. Just to sort of capture the market, I've got a slide here that shows sort of the three generic categories within structured products. I've got spreads on agency mortgage-backed securities, which is the purple line. Red line is prime autos, and the green line being senior last cash flow CMBS. You can tell from the line that we've had a pretty substantial snapback from the lows of mid-March, and we're holding in at relatively attractive levels, far cheaper than we were back prior to the crisis, but still leaving some opportunity, we think, for appreciation over the longer run. Let's start with just the agency mortgage-backed position. You can tell from that graph that we've recaptured most of the widening already, and it's no secret as to why. The Fed has been a very aggressive purchaser of mortgage-backed securities in here, much as they did back in the financial crisis. In fact, as of through yesterday, they've purchased $532 billion in securities. To put that in context, the normal net supply or the forecast supply for this year was a little over $200 billion. So they literally have bought the entire market and then some. For that reason, you can see the recovery in spreads. We don't see a lot of value in the agency mortgage-backed security position. We do, however, see, again, from a quality perspective, up in credit within the other two sectors, both commercial mortgages and in the asset-backed sector. So let's go to the next page. I want to talk a little bit about CMBS. In terms of trying to judge just where the market might go, certainly there's a lot of uncertainty, particularly within conduit supply, single asset, single or borrow transactions that are heavily exposed to hospitality and retail, specifically mall. There are plenty of concerns. Fortunately, with the diversification with the conduit space, though, as we model out what could potentially happen, we still think we're in pretty good shape. What I try to do here is just to give you some idea of maybe where we go in terms of both ratings and losses. On this, the lighter blue is sort of the forecast stress losses that we had coming into the year on various vintages, beginning in issuance in 2010 from the financial crisis and going out to the most recent. We were expecting losses at that time about 3 to 4%, so the type of losses that you would expect to incur on non-investment grade rated securities, which is sort of the assumption in most real estate deals that those are the tranches that are going to be most exposed. If we were to put a little higher stress and go back just to the recession of 2001 and 2002, we're looking at stress losses that may creep up more to 4 to 6%. Again, not really problematic, really more of a concern for the non-investment grade tranches as well. However, we go back and start looking at what it was like back in 08 and 09. Now we're back to substantially higher stresses, forecast losses on given transactions more in the 6 to 9% area. That's a pretty significant risk to current holders because those are the types of levels that we saw back in 08, 09 when we were basically wrote off the entire BBB segment of the universe. We think at this point that those are reasonable estimates for where we may see peak losses. What this means is BBBs are not only a risk for certainly of downgrade, but certainly of principal loss. We think it breaks somewhere around the single A level. Maybe the double A level should be okay from a credit perspective, but certainly much like what happened in 08, 09, it's pretty fair to assume that we're going to see a lot of downgrades in that single A and double A space. Super seniors, the triple A level with 30% subordination, we think are going to be much fine, much like in 08, 09 when there were very few downgrades at the senior triple A level. We expect that similar type experience we recognize this time, so we think we're in pretty good shape. One thing to keep in mind, there will be some dislocations in terms of principal and interest flows, at least at the loan level, but the servicers are required, much like in residential mortgage-backed securities, to advance principal interest. And for that reason, there should be no interruption of principal and interest over the short term as we work through these various issues in the market. Going on to asset-backed securities, very similar situation. We think the credit in the better quality prime auto in senior securities are more than adequately protected. Just to try to give you some idea of what happened back again in 08, 09, with unemployment peaking at 10%, the black check line is delinquencies on credit card lending. The dotted line at the bottom is prime auto. Prime only peaked at maybe slightly over 2% in terms of delinquencies. Looking at credit enhancement protection on those securities, that's 3 to 4 times those types of numbers. We really have no concern about credit at all with regard to auto. Credit cards as well, more than adequately protected. So while we do expect a spike in delinquencies and losses, particularly in the auto area and the credit card area, nothing to be concerned about again, with senior securities. As it relates to the continuity of cash flows, there are cash reserve accounts in all ABS transactions that ensures the advancement of principal and interest when borrowers become delinquent, and again, should continue to allow senior holders to recognize a regular flow of principal and interest as expected as we work through these issues. So structured products really look to be in pretty good shape this time around. We don't expect really any interruption of cash flows. Most of the problems we see in the sector are going to be realized with downgrades and losses in subordinate and mezzanine structures, but we are positioned predominantly up in very senior securities, which we don't anticipate any issues from credit or with cash flow at this point in time. I will turn this over to Greg now to cover municipals.
Thanks, Scott. Going to page, I think 18. Just looking at our outlook for the year, today we're much different from where we were at the beginning of the year. We've moved to a much more cautious outlook for the sector, driven primarily by the credit concerns related to COVID-19 and the shut-in orders. We've seen revenue losses, or expect to see revenue losses, of about $350 to $500 billion over the balance of this fiscal year and next year total. So we're expecting to see those heavy revenue losses, but we're not expecting to see widespread default levels, primarily because of some liquidity facilities have been put in place. I'll talk about those in a little bit. But we are looking at very large budget gaps developing over the next couple of years, and we're going to see state and local governments make some really tough decisions here about what they're going to do to close the structural imbalances absent any federal stimulus. If you go to the next graph, page 19. In terms of looking at the sectors and the impact of COVID-19 and across the different sectors, the biggest impacts are going to be for the higher ed, healthcare, and transportation sectors, with the utility sector seeing the lowest impacts. But across the rating agencies, for the most part, they have negative outlooks across all of the sectors. And we're expected to see more downgrades than upgrades over the next 1 to 2 year outlook period. We've already seen a number of issues downgraded, their ratings outlooks pushed to negative. We expect to see this continue over the course of the next year or two as we get more clarity on how much we're going to see in revenue losses and what issuers are actually going to do to plug their budget gaps going forward. But we really expect most of the rating downgrade pressure is going to be tied to lower rated credits with very limited financial flexibility. If you go to the next graph, on page 20, we have the stimulus programs that have been put in place. That's one big credit positive is really the mitigation efforts supplied by the federal government and the Federal Reserve. Looking at, without going through all the detail on this page, so far what we've seen in terms of stimulus is that we've had about $150 billion in direct aid to higher education, healthcare, airports, and transportation. And with the vast majority of that money going to healthcare at about $100 billion. On the state and local government side, we've seen about $280 billion in total, which includes about $40 billion from a 6.2% increase in the Medicaid reimbursement levels, and another $150 billion from the CARES Act that's tied directly to reimbursements for COVID-19 related expenses. We turn the page to 21. And on the Federal Reserve side of things, there's also been facilities put in place, the money market mutual fund liquidity program that provided some short-term funding and addressed many of the dislocations that occurred in the money market space back in March. And the muni liquidity facility that gave the Federal Reserve authority to provide about $500 billion in funding levels or lending level to state and local governments up to a 24-month term. All these programs are a great start at this point. Right now, what we're looking at is that these levels, the amount of stimulus in the programs in place are not sufficient to address the revenue losses that we're expected to see over the next couple of years. And governors are asking for roughly about $500 billion more to address their revenue shortfalls. On page 22, in looking at relative valuation levels, we are looking at the credit, the weakening underlying credit fundamentals have repriced risk in the muni space. For tax exempts, we saw spread levels, nominal spread levels to treasuries widen out by as much as 248 basis points through late March, while they were trying to address roughly about $45 billion in mutual fund outflows during that time period. Since that time, those spread levels have tightened in about 156 basis points. And what we're seeing now, that's basically been a part of the, based on the news from the federal stimulus programs that have been put in place. But on the taxable muni side, we saw spread levels widen out about 102 basis points at their widest points of dislocation. We've not yet seen the spread levels in that market move comparatively tighter relative to what we've seen in tax exempts. So what we find ourselves now is that taxable muni spreads relative to tax exempts are very compellingly wide levels across the curve. As an example, in that 10-year part of the curve, we're about 96 basis points wide to tax exempt yields that are tax adjusted at a 21% corporate tax rate. So right now we're looking at, going forward here, we're looking at taxable munis as an attractive asset class. And in terms of credit, we're being really selective about credit going forward here, staying up in quality and avoiding what we consider the weaker, lower rated credits, which we think are going to see more downgrade pressure going forward. Now I'm going to turn it over to Tim Seneschal to talk about converts.
Thanks, Greg. So flipping ahead, covering the convertible sector, balanced convertibles have, as illustrated here on slide 24, with a graph of the balanced sector's performance dating back about a month relative to various equity markets. they've preserved capital reasonably well amid this heightened level of volatility. As we look back from roughly the third week of February through the third week of March, the peak to trough of the market, the S&P 500 dropped 34%, the Russell 2000 declined 41%, and equities that underlie balanced convertibles in the market here in the U.S. declined about 37%. So against that backdrop, the balanced convertible market bottomed out roughly 21% below its February highs, a bit worse than half of the downside of underlying equities. So valuation models would indicate that downside should have been a bit more muted, looking for less than half the down capture in a market move like this. But with the severity and speed of the equity market move, the amount of spread widening in credit markets, both high grade and high yield, and broad-based illiquidity that Reed described earlier, all of those things came together to contribute to some additional cheapening in valuations in the market. Some of that cheapening has reversed here. You see the recovery that's taken place from the lows of late March. Some of that has come back in terms of valuations, with stocks having rebounded, implied credit spreads having narrowed a bit, and liquidity improving. So as we stand here today through yesterday's close, on a year-to-date basis, the balanced convertible sector is down about 9%, with underlying equities having fallen roughly 18% over the same period. Flipping ahead, just kind of talking about portfolio activity. This environment, these market moves are creating opportunities to better structure, better position portfolios for the gradual recovery that's expected over the 1 to 2 year period ahead, while insulating investors in convertibles from near-term volatility, which is likely. Our partners at Zasoff that run these strategies for us and for our clients are focusing on structure, quality, and diversification to ensure that upside capture is balanced appropriately with downside risk control. First, on the structured side, a portion of the market has lost upside potential following the market sell-off. So these bond-like names that have traded down have become sources of funds in recent weeks. On the other side of the coin, tech shares have been pretty resilient in here and have rallied back, with some issuers actually posting new highs lately. Their convertibles have become too equity sensitive in certain cases as a result, and both of these conditions are prompting turnover as Zasoff repositions portfolios and those securities into more balanced issues. From a quality perspective, our investment grade average rated portfolios are higher quality than the broad convertible market, and that's helped performance at the margins. Given the continued near-term uncertainty in the economy and in the markets, the analyst team at Zasoff is scrutinizing issuer credit quality, both with existing holdings as well as with prospective purchase candidates, to really ensure that their issuers and credits with ample liquidity to manage this near-term disruption, and that their businesses aren't subject to fundamental changes in operations on the back end of this thing. With respect to cash and sales proceeds and buys on the other side, we're targeting 3 areas. First, opportunities to add names that previously were extremely equity sensitive, but are now better balanced, having traded lower. Second, synthetic issues, which have cheapened amid this volatility. These things, as a reminder, are the combination of a debt obligation from a major bank with a different underlying equity exposure attached to it. So traditionally, these high quality bank-sponsored issues, single A, double A rated, trade rich to the straight market, but today they offer better value with that very high quality and unique underlyings. And then last but not least, the new issue markets have opened and are active again, and I'll talk a bit more about that on the next page. On the new issue side, on page 26, the market did shut down in mid-March for a couple of weeks, but has since reopened with $7 billion or so pricing in the U.S. market in the last couple of weeks. And so that's That's brought us to a year-to-date total over 20 billion on the gross side, with almost 17 billion positive net supply, which is nice to see continued organic growth in the market. With that new supply, terms have improved meaningfully for investors with higher coupons and lower conversion premiums relative to just a couple of months ago. Notable among those deals, Carnival Cruise Lines, which is waist deep in the shutdown. They themselves issued $2 billion in the convertible market earlier this month as part of a $6.5 billion capital raise. That 5-year secured deal came with a 5 3/4 coupon and a 25% conversion premium off of an $8 equity stock price at issue. And just for reference, shares of Carnival were trading in 50 in January. So those terms and subsequent recovery in value of shares have led that new issue to trade up more than 30 points since it came to market just a couple of weeks ago. Other issues include Booking, the rebranded Priceline, which issued converts as part of a large benchmark offering on the debt side, as well as Slack, both of those 850 million or more in total size, and again, terms that are more compelling than would have been the case just a couple of months ago. So when combined with the dynamics described on the previous page, new issues are providing additional opportunities to enhance portfolio risk return and diversification attributes. I'll wrap by just commenting that we at AAM and our clients are strategic investors in the asymmetry that balanced convertibles offer, but would note that the risk rewards in the market today look particularly attractive, considering the uncertainty that we're expecting in the near term for equity markets. We view converts as offering excellent value today. With that, I'll hand it off to Scott to talk speculative grade credit and bank loans.
Okay, thanks, Tim. So I'm going to pick it up on the next page. So this page here shows the historical credit spreads for the high yield market over the last 10 years. And as you've already heard, the repricing of risk assets in March was severe, and it led to the largest credit spread widening in the high yield market in the last 10 years. As you can see, looking at the 2020 area on this page, credit spreads hit a low for the year at about 350 over at the end of January, but then quickly widened over 700 basis points, reaching a peak of just over 1,000 on March 20th of this year. The market was pressured by exposure to energy names, which represent about 12% of the high yield market, but also pressured as investors withdrew $19 billion from the high yield market during the month, which was the largest 4-week outflow from the sector in history. Since that time, you can see that spreads have tightened to over 250 basis points. But as we sit here today, they remain significantly wide of their long-term average that's in the mid 400s. For perspective, that computes to an all-in yield of about 8.25% as we sit here today. On the next page, I'm going to talk about returns for the year. So this page here summarizes the total returns for both the high yield and leveraged loan markets for the periods of year to date at the top of the page, as well as month to date during April at the bottom. The key takeaway here that you'll notice pretty quickly is that the lowest credit quality segments of the market have significantly underperformed, both on the way down as well as on the way back up as the market has recovered in April. On a year-to-date basis, the lowest quality segments have underperformed the highest quality names in high yield by over 15%, and it's nearly 20% on the loan side of the market, where the lowest quality issuers have been further pressured by CCC limits and CLO holdings. I'll move on to the next page, which is page 30. And as Elizabeth mentioned up front, we're expecting up to $500 billion in fallen angels out of investment grade and into the high yield sector in 2020. And the exhibit at the top here shows how historically spreads for fallen angels typically underperform heading into the downgrade to high yield, given selling pressure from investors who can't hold below investment grade bonds, but then they generally outperform following the downgrade as high yield prices recover. On April 9th, the Fed announced support for fallen angels by adding them to the list of corporate bonds that are eligible for them to purchase. Again, something like this has never happened before. So to illustrate the impact of that, you can see in the chart at the bottom, this has led to significant spread tightening of the issuers that qualify to be purchased, even more so than what's been typical in previous years. So what about defaults? Moving on to page 31, while valuations for both high yield and leveraged loans are attractive, defaults are expected to accelerate this year, led primarily by weaker energy names in the high yield space and the higher prevalence of more highly levered LBO-related issuers in the loan market. I should emphasize that these are broad market estimates, inclusive of the lowest quality names, not what our partners at Muzinich expect in their own portfolios. Accordingly, it's critical to use an actively managed approach for each asset class that's designed to minimize impairments in this type of environment. For that reason, Muzinich is currently focused on higher quality issuers and better capitalized fallen angels that have much stronger balance sheets to weather an extended downturn. Moving on to page 32, I want to talk about what this current spread environment looks like historically as an entry point to the sector. So what the blue dots represent on this page is what the 3-year future returns have been in the past using spread levels on the x-axis as an entry point to the asset class. If you use today's spreads of around 750 as an example, the blue dots clustered around that level indicate that historically, the lowest 3-year cumulative return from that entry point level was about 20%. So to recap, as you've heard in similar themes in investment grade credit, structured credit, municipal bonds, given where we are in the cycle today, we think it's an attractive entry point to each sector, but we think you're best suited with a strategy that's focused on the higher parts of the market, higher quality parts of the market, and an actively managed approach to help navigate any continued volatility. With that, I'm handing it back over to Scott Edwards.
Okay,
Thanks,
and
Scott. Go ahead.
I was going to say the reason you're going to hand it over to Scott Edwards is because we like leveraged loans, but we're not yet ready to pull the trigger yet on CLOs. Scott, what's up with that?
Thanks, Reed. Yeah, I think it's important that people understand that there is a difference in approach here. As Scott pointed out, Muzinich is really focused on higher quality defensive leveraged loans at this point, where they see a lot of upside in navigating a fairly difficult investing environment. The CLO market on hand is a little different. Although backed by leveraged loans, there's a much lower quality of loan that goes backing a CLO. A lot of that is the diversification requirements, but also just the need for yield and spread in those vehicles to make the arbitrage the vehicle work. As we look at it now, there is quite a bit of risk still in the CLO market that is yet to materialize. It's not so much the defaults that you need to focus on, though. It's just the mere existence of the downgrades. What happens is that when the rating agencies downgrade a security from single B to triple C, there are a couple of tests that there are haircuts to underlying collateral. That is a reduction in those values that impair what are called over-collateralization tests. Those tests affect the cash flow that may be received by various tranches in the securitization. The short of it is that triple C level fills up, cash flow is cut off the tranches, and the rating agencies are going to downgrade securities. And we're already seeing quite a bit of stress on that level. The limit for triple Cs in an average CLO is 7.5%. Market-wide, those levels are more like 11%. And given the outlook for more downgrades in the leveraged loan sector, we think that there are going to be more and more downgrades to triple Cs within the collateral pool of a CLO. What that means, you're going to see more downgrades to the CLO securities themselves. So for that reason, we think it's much too early to be investing, particularly down in credit in the market space. Currently, Moody's has got watch listed 30% of the outstanding single B and triple B classes for downgrade. And we think it highly likely that a major portion of that entire market will be below investment grade in the coming months. To get some context to the prior, in the great financial crisis, approximately 70% of the single A universe was downgraded below investment grade, and we think that's a very good likelihood now as well. So we see a lot of risk in the space, particularly 20% of the underlying credit ratings in a CLO are already B-. So there's a lot of loans that can migrate to that triple C bucket. So we see much higher downgrades in the leveraged loan space, which is going to translate into a significant number of downgrades in the subordinate tranches of CLOs as well in the coming months. So we think it's very risky to really be involved in anything right now below the AAA to AA levels. And frankly, given those downgrades, wouldn't surprise me to see incremental pressure on even the senior securities going forward. So a lot of risk out there in the CLO market. We think it's a little premature to be getting too aggressive in the space, at least for the time being.
Okay, thanks, Scott. All right, so let's sum up our views. If we go to the next page, Peter. So we think that the economy will start to pull out of this slump beginning in the third quarter. There's still a fair amount of uncertainty what that looks like. What does it mean if we need to keep practicing some level of social distancing overall in our society? Maybe we don't fill up a football stadium. There will be a little bit less economic activity going forward, but it's impossible to know what that's going to look like. So today what we're doing is we're taking opportunities to add companies with strong balance sheets at attractive levels. So you see where we're positive in A or rated or better corporate bonds versus being neutral in triple Bs, even though they've performed worse here. As you move down this page, you see taxable munis. Greg highlighted the risks in this sector, but that means that there are still some gems out there that offer attractive spreads and are high quality and will be able to weather the storm. And so we're using this period right now to help our portfolios add these high quality issuers that maybe we traditionally wouldn't have purchased just because the relative value of them was not attractive for our yield enhanced strategies. As you move down the list, you see we're positive in convertibles and high yield and leveraged loans, but negative in CLOs. Thanks to Scott for highlighting the difference there. And then the S&P 500, we've seen a strong move here up in prices. At the same time, our expectation and the market's expectation of earnings going forward is down. So believe it or not, today the forward PE for the S&P as it's been all year. So we're neutral in that sector. Again, we're not trying to hit home runs today, but rather establish positions that can weather whatever storm may come. Does anyone have any questions or anything that you would like us to cover more in depth? I don't believe I see any emails in this chat. So I think that we've maybe I think we've covered everything. I hope I'm looking at this properly. But thank you very much for signing on with us and for joining us today. This slide deck will be available via email, or you can check out the website and pick it up there. And if you have any questions that you think of, run them by your portfolio managers and we'll get you an answer right away. Thank you so much for joining us.